Today we're taking a closer look at IWM, the iShares Russell 2000 ETF, one of the most well-known and widely used ETFs for gaining exposure to U.S. small-cap stocks. If you've ever looked beyond large caps like the S&P 500 and wondered how to access the smaller end of the U.S. equity market, IWM is often the first fund investors encounter. IWM tracks the Russell 2000 Index, a market cap-weighted index made up of U.S. companies ranked roughly 1,001 through 3,000 by market capitalization. In simple terms, this index captures the small-cap segment of the U.S. stock market, sitting just below large and mid-cap stocks. One of the biggest strengths of IWM is its breadth. The fund holds a very large number of companies, making it one of the most diversified ETFs in the small-cap space. Rather than focusing on a narrow theme or a specific style like growth or value, IWM provides broad exposure across sectors, industries, and business models within U.S. small caps. Because the index is market cap weighted, larger small cap companies carry more weight, but IWM still reaches deep into the market. Notably, the fund includes exposure to micro-cap stocks, companies that are very small and often earlier in their business life cycles. This is an important distinction because not all small-cap ETFs go to this far down the market cap spectrum. Including micro-caps can increase both risk and potential reward. These companies can be more volatile, less profitable, and more sensitive to economic conditions. As a result, IWM has historically exhibited higher volatility and a higher beta than more neutral or blended equity benchmarks. That extra volatility is the trade-off for broader exposure and higher long-term growth potential. At the same time, including microcaps is not necessarily a flaw. For investors who want true, comprehensive small-cap exposure, this approach can be seen as a feature rather than a drawback. Small-cap stocks have historically outperformed large caps over very long periods, although that outperformance tends to come in cycles and is rarely smooth. Another reason IWM remains so popular is liquidity. It is one of the most heavily traded small-cap ETFs in the market, which makes it attractive not only for long-term investors but also for traders, hedgers, and institutional users. Tight bid-ask spreads and deep liquidity make it easier to enter and exit positions efficiently. From a portfolio construction standpoint, IWM is often used as a satellite holding alongside large-cap or total market ETFs. It can help tilt a portfolio toward domestic economic growth, since small-cap companies tend to be more U.S.-focused and less exposed to global revenue streams compared to large multinational corporations. That said, IWM is not a low-risk ETF. Small caps tend to underperform during periods of rising interest rates, tight credit conditions, or economic slowdowns. Investors should expect larger drawdowns during market stress compared to large-cap funds, and patience is often required to capture the long-term benefits. The bottom line is this: IWM offers one of the most comprehensive and widely accepted ways to access the U.S. small-cap market. Its broad diversification, inclusion of microcaps, and strong liquidity make it a cornerstone ETF in the small-cap category. For investors who understand the added volatility and are investing with a long-term mindset, IWM can play a meaningful role in a diversified equity portfolio. If this breakdown was helpful, make sure to like the video, subscribe to the ETF Investor, and comment below. Do you prefer broad small-cap exposure like IWM? Or do you lean toward more targeted small-cap strategies?